So I've been wondering what's keeping a lot of investors or retirees from getting involved with fixed rates. We're looking at 3.5%, 4%, and upwards of even 5% on some of these longer durations. And I think there are two things we're going to discuss today. The first is that investors are hearing from the Feds that interest rates will continue to rise, and so they figure, well, why don't I just hold off for a higher rate of tomorrow instead of the lower rate of today, which is a valid argument. And then secondly, they're hearing from people like insurance agents or advisors that they need to get started today. And, it's always a good time to buy when you're hearing from somebody who's, well, earning a living off of you making that investment. And so the client's stuck somewhere in between and unable to move. Well, today I want to show you and give some compelling evidence and reason using a calculator as to why you would get started today versus waiting till tomorrow. So let's jump into the calculator and I'll show you guys why that makes sense. So here we are in the calculator that I built, but before we continue, please understand that this is for educational purposes only and not meant to be taken as financial or tax planning advice and not to be implemented. It's just to help educate retirees. So here's a disclosure up at the top you guys can read. I'm going to scroll down a bit. We have a balance, and I'm just starting with an even round number of $100,000 to make the math very simple for us to understand. We've got an offer on the table from a life insurance carrier in California on a 3-year for that $100,000 at 3.9%. It's a fixed rate. That means that they're going to pay you that 3.9% every year for the next 3 years. And at the end of the third year, you're going to need to go pick your money back up. And so they're not going to guarantee you that offer beyond the 3 years. That 3.9% will come down to some minimum, probably like what they pay on a savings account at the bank. So just keep that in mind. At the end of the third year, we've got to look for a new offer. Now, scrolling down just a bit, this is pretty straightforward. I've got the month because we're going to compound monthly. And then we've got a starting balance of $100,000. We see it there. And all I do is this little formula says, hey, multiply the $100,000 by 3.9%, divide that by 12. And we've got $325 in that first month earned, and that's added to the balance. In the following year, we take that balance forward down to February. And now we are going to be compounding off of this figure using the 3.9% divided by 12. And we have $100,651. So, this is pretty straightforward. The balance of this account is just simply growing month by month by month based on that compounding interest that's happening on that 3.9%. Now, as we move a little bit lower, we're getting into year 2. So I could probably change this and just, let's just add a row here, say add row, insert row. We'll just put here to make it easy for you guys, year 1. I make these on the fly, so hopefully that's not alarming to you. 3. All right, great. So in the second year, though, the point I wanted to make was that we're just simply taking that 103, that ending value, about 104, and we're carrying that into year 2. And then we start the same process. We see the interest that we're earning is getting higher over time because our balance is getting higher. It's the same 3.9% offer for 3 years, but since our balance is growing, we earn more interest on that larger balance with that 3.9%. So that's growing and growing, and then we get into our third year, and we carry the 108.99 down here, and then that continues all the way down to the end of that third year. And at the end of the third year, we will go and pick up $112,391. And so we've earned $12,391 on our investment over 3 years of time, on our $100,000 investment over 3 years of time. So not bad. There's your 3.9% over those 3 years compounding. Now the question becomes, what if we were to, instead of investing today at 3.9%, if we assume that rates will continue to rise, hold off for another 12 months and invest at that time, assuming rates have risen by 1%. So we're going to assume the future rate 12 months from now is going to be 4.9%, a full percent higher, which is not impossible. So if that's the case and we invest then, how many years will it take for us to break even on compared to starting today? And the way we figured that out is I've gone ahead and built another series of columns to the right of all this, where I have begun investing that $100,000 exactly 1 year later. And so if we move to the left, we can see we're in the second year of that first account. So looking at this for just a moment, we've got 1 year later, 4.9%, and we've got our same series of months. The difference here is our $100,000 on that first month, well, we're earning more interest. We're at $408 per month in our first as our first interest payment collected. Whereas when we started the year before, it was only 325. So we're up right out the gate on how much we're earning by like $70 or $80. This is why people think it's better to wait, because they know that payment in the future will be higher. Now let's just keep forward though. If we look at the balance, we can see it's running up and all the way down to 105,000. So the question is, at the end of the 12 months, is the balance higher in the account we started later or the account we would have started earlier? Well, let's just take a look to the left. We've got 105 here at the end of the first year in the second account, the one that started later. And what did we have in that first one had we started earlier? 108. So 105 versus 108, and it would have so far been a better decision to start earlier than later by the end of, well, the second year for the first account and the first year for the second account. So far, it's better to have started earlier. Now, moving on down to the second year, I'm going to try to move pretty quick through this because the interest payments you see are just growing. As the balance growing, that makes sense. And so the balance is here on the right. And then we just want to fast forward to the result of what the account balance is by the end of the second year inside of the account we started later. It's 110,274. Does that beat what we'll have in the initial account starting today by the end of its third year? So we just look, 112,391 versus 110,274. It's not. So still, it makes more sense to have invested in the initial account starting today. It makes more sense to invest today at 3.9% than it would to invest a year later at 4.9%, a whole percent higher. Now, in year 3 for the second account, the one where we started a year later, we deferred. Well, we've got $450 per month now. That's growing by quite a bit. The balance is getting pretty strong. And we've got 115,801, and we want to compare that to, I think we already did this one. Oh no, the fourth year here. So we have not. So this is down here on the third year of that second account, and we've got 115,08, just getting straight to the point now. We compare it to our account still earning 3.9%, which technically this is where the argument breaks down, because we wouldn't have a fourth year in this first account. The offer expires at the end of the third year. So realistically, we would get prevailing rates. And if we follow the argument through that rates are only going higher, this account would be invested at today's much higher rate. And it should be higher than 4.9% since it's a year after we received the 4.9. Should be 5.9, right? But I'm just going to assume that we're going to continue growing at the 3.9%. And so we look at the end of the third year for this 4.9% account, and we compare it to our starting early account, and it's 116,853 versus 115. We still have not broken even. As a matter of fact, we don't break even till the end of the fourth year, right here around November of the fourth year of that second account, the fifth year for overall. Since you had the chance to make the decision, you broke even at 121, 110. Right here, 121.99. It's hard for a lot of investors to wrap their head around, but starting earlier often makes more sense than waiting when it comes to fixed rates. And we see the power of that in the calculator, because you begin compounding today and it just takes a long time for that percent higher to catch it. The only time this wouldn't make sense is if that rate 12 months from now was just a lot higher, say closer to double what our offer was getting started today. So we get about 4% today, 3.9, call 4. And if it was 8% tomorrow, then the break even would just come a lot sooner. You know, maybe a year or two, or maybe a year and a half. I don't know the math, we'd have to run it. But that's the only time it can make a lot more sense, is if that future rate was higher. But I think 1% is reasonable. 1% higher 1 year from now. Rates shot up there pretty quick the last 6 to 8 months, but I don't anticipate those rates growing at that speed, that velocity over the next 12 months. And so that's something to consider, is that getting started today, like you guys saw, is better than waiting on a rate that may not even ever happen. That's the other part, right? We might not see that percent increase, and things could end up going the other way, because eventually they'll have to re-stimulate the economy once they get to their target. Another consideration for those of you who aren't convicted that now is a good time to get situated with the fixed rate is bond laddering or CD laddering, where you can use these fixed rates and you can kind of stagger them. So you can buy a 1 year, 2, 3, 4, 5. And what you do there is you create yourself a higher average as opposed to just buying the 1 or 2 years. And what's also nice about it is that as every year comes forward, you're taking and able to liquidate what you have and kind of look around for hopefully a higher prevailing rate. And if not, maybe some other market opportunity. But the idea there is that you're not really giving up your liquidity to a 3, 4, 5 year product. It's more like every year you're seeing some of those funds become available. And then again, you can kind of push that to the back. You can buy, let's say rates are higher, you can buy a 5 year to kind of renew that ladder. And so that's another kind of recommendation or strategy that we've used for clients here at the firm. So yeah, if you guys want to learn more or have any questions, you're more than welcome to reach out to us. Thanks so much for tuning in, and we'll see you in the next episode.